Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And as you probably know by now, in my Wednesday episodes, I talk about the theories, methodologies and principles associated with investing. The aim of these case study episodes is to share some real client experience to show how that approach works out in the real world. Now, I'm going to add a Q&A section to my regular Wednesday podcast. So if you have any questions, feel free to email them in. You can send that to questions@investopoly.com.au. So I've got the first question to talk about in tomorrow's episode, and hopefully we can add to that and add some additional questions. So send them in if you've got any questions. I look forward to having a go at answering them. Okay, so let's get into today's case study episode. I'm going to take a slightly different approach with this one. I'm going to give you a bit of a rundown of where these clients started and what their financial position is today. And then I'm going to share what they did right and what they didn't do or what they could have done differently. I don't want to say wrong because they're in a great financial position, but what could have they done differently? Ultimately, with these case study episodes, what I'm really keen to share is if a client's taken a certain approach and it's worked out really well, let's talk about that. So, because it gives you an idea that, if you take a similar approach, what the results might have been. But, few people get it 100% right. So again, hopefully we can learn from other people's mistakes. So let's then also focus on the, what could have they done differently question. Okay, so as I said, let's start with a bit of a rundown. So we started working with these clients about 15 years ago. They first approached us in 2009. And when we did some initial advice, we did an initial plan for them. Then they went away and implemented that plan. They came back 6 years later and engaged us for ongoing advice. So we've only been providing ongoing financial advice since 2015. So there's a bit of a gap there. And, just as a bit of a background, back in sort of that era, '09 and prior to that, we really were only doing once-off advice. That is, we develop a plan, give it to a client and say, okay, there you go. You now know what direction you're heading. And we worked out that actually that's not the best approach and it will become obvious because sometimes clients will take that plan and won't implement it correctly, that they might add their little bit of, additional sort of approach or, change the approach a little bit, or they might speak to other advisors like a buyer's agent and get talked into going down a different direction. And so, look, I can't remember when it was, but certainly after 2009, we changed our approach and realized, look, clients really just need ongoing advice. Well, they need upfront advice, a strategy, but ongoing advice is really where the value is, because you can have the best plan, but if it's not implemented correctly, that's where you forego the value. Anyway, so that's just a bit of a sidebar really to this case study. Anyway, in 2009, when they approached us, when we did the initial upfront plan, they had about $1.8 million of cash. I can't remember where the cash came from. It could have been a property or business sale or even inheritance. I'm starting to think it's a business sale. In any case, 1.8 million of cash. Their home was worth 1.5 million at that time. They had 1.5 million in super. So, their starting point was pretty strong, right? $4.8 million of net worth. At the moment, they've got $4.7 million in super. They've got an investment property outside of super that has about $1 million of equity in. They've got nearly $700,000 of cash, and their home's worth 2.5, and so their net worth is $9 million. So it's gone from 4.8 to $9 million since 2009. Not bad, but not fantastic, and it'll become obvious why that's the case in a second. Between 2009 and 2014, so remember we did that upfront plan, sent them away, go and implement the plan, and I'll come back to, their implementation of that plan in a second. But between 2009 and 14, they purchased 5 apartments. There was 2 apartments in Sydney. One apartment has grown by 5.4%. The other apartment has grown by over 7%, that's really their standout asset from a performance perspective. And then they bought 3 apartments in Melbourne, and there'll be no surprises that they've all underperformed. So 2 have returned about 2.8% compounding growth and 1 3.6%. So not such great outcomes. 3 properties were purchased inside a self-managed super fund. Remember back then they had quite a bit of money in super, and at that stage a lot was in cash, which again kind of says to me that it's probably a business sale where they got the cash from. One was in a trust and then one was in personal name. So various ownership structures there. As I said, now they've got about $4.7 million in super. That consists of around about $2 million in shares and bonds and $2.7 million in property. Remembering the property that they've got in super, 2 apartments in Melbourne and 1 in Sydney. The one in Sydney's done really well. As I said, the 2 in Melbourne have done very poorly. They're in an enviable financial position in that they don't really need to worry about money. They've got more money than they'll probably ever need, despite the relative underperformance of the apartments, of course. And they've been in the position where they've been able to help one of their children with a cash contribution towards a property purchase, and plans are to help their second child also with the same contribution. So, some of our goals to fund retirement and be in a really comfortable and safe financial position. And a lot of people's goals are to eventually help children. And so if you get yourself into a position where you have, a really strong financial position and arguably surplus assets, surplus to your needs, then you're definitely in a position where you're able to help children and get them onto that sort of property ladder. So let's talk about, what they've done well and what they could have done differently. So the first thing which I commend is they've always seek professional advice. So we did the initial financial plan for them, and then when they went to do the implementation, they used a buyer's agent to select and purchase all their investment properties. They did that with all their investment properties except their home. They changed their home, they made a decision there, but that's a lifestyle decision, right? So we're probably unfair to look at that one. The second thing they did well is they built in some geographical diversification, and we all know the story around investment grade apartments in Melbourne and their relative underperformance over the last 10 to 12 years. Apartments have done pretty well as a general observation in Sydney. So this case study proves to us that geographical diversification for those reasons is valuable. And we know markets move in different cycles, so different states will be at different points of that cycle, be it a flat cycle or a growth cycle. And so spreading your eggs in many baskets kind of almost always makes sense. Once the acquisitions were completed, so as I said, between 2009 and 2014, they purchased 5 apartments. So they're obviously spent 5 years acquiring these assets, borrowing to acquire these assets. Once that was done, the next phase of their focus was really on debt retirement and investing in other assets. So that is building that share portfolio. And that's where we started working with them in 2015 to help them do that. And as I said, they've got 4.7 million in super, 2 is in bonds and shares, and 2.7 in property. And they've got a very conservative rate of gearing against that property now. So it's certainly positive cash flow, but they've also got a lot of liquid assets now that they can start paying pensions from. And whilst they might sell a property inside super eventually, they don't need to. They've got enough diversification. So I've previously spoken in this podcast, building wealth is kind of done in 2 steps. Firstly, you need to build your asset base. That's typically done through gearing. Gearing's best done with property because property provides most of its return in capital growth. So therefore you can benefit from compounding capital growth. That's the first step. The second step then is tilt towards income or tilt towards assets that are going to provide more predictable levels of income and also are more liquid so that we can gradually sell down if we want to. And they've done exactly that. So they've done a really good job of transitioning, I guess, their focus from borrowing to invest in property to, invest in shares and bonds. And lastly, they've managed cash flow really well. I mean, they've always been quite prudent around, financial expenditure and so forth, not to the point, they've enjoyed life, of course, so they're not sitting at home, eating day old bread or anything like that, but they have been really focused on monitoring cash flow and monitoring wealth and reviewing their properties, reviewing their share portfolio with our assistance, of course. And, it goes back to the old adage, what gets measured gets done. And it's really important. You can't manage what you don't measure. Okay, so let's look at what they could have done differently. There's probably one thing that they could have done differently and one thing with the benefit of hindsight that ongoing advice could have helped them. Not that we really had the right business model to sort of deliver on that at the time back in 2009, but in any case, I'll get to that. One thing they could have done differently is that our initial advice to them back in 2009 was to go and borrow to buy 2 higher value properties. So really 2 houses rather than apartments. What they ended up doing is investing more, borrowing to invest in more properties, okay, but more lower value properties. So 5 lower value properties properties where we were kind of aiming, or our advice, in fact, explicitly said, to higher value properties, which were really houses. Now, benefit of hindsight, you look back and go, well, yeah, houses have outperformed apartments. That advice was bang on. It was really aimed at quality over quantity, and it always is. And in this situation, it would have turned out better. Now, they've got some good quality assets. They are fundamentally sound, good quality assets. Yes, sure, they've underperformed, but I've spoken on this podcast recently as last week. Property is very much a long-term asset. You buy at the wrong point of the cycle, you've got to hang on for 20 or 30 years to enjoy the results. So I am absolutely confident that they can continue to hang on to these assets, and they can, that the returns will be what we expect from investment grade apartments. So it's a little bit unfair to make a judgment now, because we're kind of like at half time and you can't reward a winner at half time. But I guess our initial advice was different, which leads me into the second thing that they could have done differently, which again, as I said, a little bit unfair, but it really does highlight the value in implementation of a plan. So if you go off to, and this is not a criticism necessarily of buyer's agents or anything like that, but if you go off to a buyer's agent and say, okay, this is what my financial advisor said, go and buy 2 houses. It's possible that for very well-meaning, reasonable reasons, that buyer's agent might say, no, well, I reckon you should buy some townhouses or some apartments or whatever it might be, without necessarily knowing, the basis of which we made that recommendation, or it might be just sort of a different approach, if you like. The point is that it's easy to develop a strategy. The challenge really is in the implementation of the strategy, because you've got to navigate market conditions, you've got to navigate personal circumstances, risk appetites, all those sorts of things. And you've got to do that without diminishing the value of that original strategy. And so in this situation, I wouldn't have gone out 5 apartments. No way would have I ever recommended that. Of course, I'm happy to invest in apartments, but let's have a mixture of houses and apartments, exactly like I do personally, right? I don't own all apartments, I own houses and apartments. For that very reason, that diversification is a good idea. And we're property investors, and we know that we've got to hold those assets for 20, 30 years or even more to really enjoy the returns. So I picked this case study because I thought, it was a good one. It's worked well for them. The diversification's worked. Yet again, it's another case study that includes apartments that haven't performed over the last 10 years. They will work. I look forward to re-recording this case study in 10, 15 years from now to say, see, I told you so. No, that sounded a bit arrogant, but I'm confident I look forward to recording these in the future to demonstrate once again that, hey, in 2024, it wasn't looking good, but look where it's ended up now. Having said that, they're in a really strong financial position. They don't need to really worry about money. And in fact, they don't really need to worry about the relative underperformance of their apartments either. But I picked this case study because I thought it demonstrated really well the value of good quality implementation and working with an advisor ongoing. This is not a sales spiel, of course. It's because I genuinely believe in the value of that approach, and somewhat stupidly didn't recognize that back in 2009, because if I did, we would have obviously structured our business a little bit differently. Okay, so as I said, if you've got any questions, don't hesitate to send them to me. questions@investopoly.com.au is the email address, and I look forward to chatting to you again tomorrow. Cheers.